In the labyrinth of financial markets, few variables tug at the wallet of the average American homeowner as significantly as the fluctuating whims of the Federal Reserve's interest rates. Imagine this. You've just locked in a rate for a new home, only to find out that the Fed has shifted its policy, potentially saving or costing you hundreds of dollars each month. Understanding this dynamic isn't just a scholarly pursuit, it's a financial necessity in an era where home ownership remains a cornerstone of personal wealth. The dance between Federal Reserve rates and mortgage rates has been a defining feature of the U.S. housing market for decades. Historically, when the Fed adjusts its rates, either upwards or downwards, mortgage rates tend to follow, though not always in a linear manner. The relationship is complicated by factors such as lender competition, global economic pressures, and investor behaviors, which can all influence how closely mortgage rates track with Fed decisions. The graph above illustrates periods of major divergences and convergences between Fed rates and mortgage rates. Notably, during the early 2000s, mortgage rates remained relatively low despite incremental increases in Fed rates, partly fueled by an influx of mortgage lending and financial deregulation. Conversely, the aftermath of the 2008 financial crisis saw a tighter alignment as both rates plummeted in response to economic uncertainty. Understanding these historical patterns is vital for predicting how future economic or policy shifts may affect mortgage rates. It's not just about the numbers, it's about the stories they tell of economic resilience and the interplay of market forces. As of 2024, we are witnessing an intriguing phase where the Federal Reserve has started to incrementally increase rates in response to inflation concerns. A situation markedly different from the all-time lows observed during the pandemic years. This shift has direct implications for potential homeowners and real estate market dynamics. The current average mortgage rate has seen an uptick, reflective of the Fed's policy changes, but the response has not been uniform across all lending institutions. The data from recent months highlight a nuanced landscape where some lenders adjust rates more aggressively than others. This variance can be attributed to differing risk assessments, capital flows, and perhaps a recalibration of lending strategies in anticipation of further rate hikes. These trends are crucial for current and prospective homeowners to monitor. They not only affect the affordability of mortgages, but also influence broader decisions about buying, selling, and refinancing homes. With financial technology also playing a role, the market's response to Fed rate changes is becoming increasingly sophisticated and diversified. To deepen our understanding, conversations with economists and housing market analysts shed light on what to expect in the near future. Most experts concur that the era of exceptionally low mortgage rates is likely over, with predictions leaning towards gradual but steady increases over the next few years. This would align with the Federal Reserve's stance on curbing inflation without destabilizing the recovery post-pandemic. These insights suggest that potential homebuyers should be prepared for a more dynamic interest rate environment. Financial planning and flexibility will be key, as the ability to lock in favorable rates might require timing and a bit of luck. Moreover, existing homeowners should consider the benefits of refinancing at strategic times to capitalize on rate fluctuations. For aspiring homeowners, the interplay between Fed rates and mortgage rates is more than academic. It directly impacts their buying power and the timing of their purchases. As we project forward, it becomes clear that those in the market for a new home need to stay informed and agile. Strategies such as rate locks or choosing adjustable rate mortgages might become more prominent as individuals and families navigate this changing landscape. In conclusion, whether you're a financial veteran or a first-time homebuyer, the relationship between Federal Reserve rates and mortgage rates is a critical piece of the housing market puzzle. By staying educated and responsive, stakeholders can navigate these waters with greater confidence and strategic insight, turning challenges into opportunities.